Friday, January 9, 2026. This is a date that history books might one day record as the moment the illusion of market stability finally shattered. While retail investors were distracted by New Year headlines, a $14 billion trapdoor was quietly pulled open beneath the precious metals market. We aren't talking about a rumor or a speculative dip. We are talking about a mandatory contractual execution. Institutional banks are being forced to dump massive positions in gold and silver within a brutal 5-day window. If you've been watching silver hover near $80 and wondered why it hasn't rocketed to $100 despite the global chaos, you are looking at the reason. Tonight, we analyze the Bloomberg Commodity Index rebalancing, a technical mechanism being used as a weapon of mass liquidation. Is this a collapse, or is it the ultimate shakeout before the greatest wealth transfer in modern history? We are stripping away the propaganda to show you exactly how the smart money is positioning itself while the public is being led to the slaughter. To understand the magnitude of this event, we have to look at the mechanics of the BCOM, the Bloomberg Commodity Index. This isn't about sentiment, it's about math. Because silver and gold performed so exceptionally well throughout 2025, these deep, massive index funds now find themselves overweight. The rules are cold and inflexible. By contract, they must rebalance. They aren't selling because they think silver is overvalued. They are selling because their bylaws demand it. The numbers are staggering. We are witnessing the forced sale of $7.1 billion in silver and $7 billion in gold. This represents approximately 17% of the entire open interest in the March silver futures contracts. To put that in perspective, imagine trying to force nearly 1/5 of all active trading volume through a single exit door in just 5 trading sessions. Scotiabank's internal analysis, which has been circulating among institutional desks, confirms the pressure. This is what we call structural selling. It doesn't care about support levels, it doesn't care about your stop losses, and it doesn't care about the news. It is a mathematical sledgehammer hitting the market at precisely the moment when physical supply has never been tighter. The fiction of the spot price. The most critical thing for any investor to understand right now is the total divergence between the paper market and the physical market. When you see silver quoted at $78 an ounce on your screen, you are looking at a digital derivative, a promise that may never be fulfilled. In the physical world, the story is a nightmare for the bears. Major bullion dealers across North America are already reporting empty shelves. 100-ounce bars that used to ship in 48 hours are now on pre-sale for mid-February. Premiums have exploded to nearly 10% above the spot price. What happens when $14 billion of paper selling hits the market this Friday? The spot price might drop to $70, but the physical price will likely stay at $80 or higher as dealers hike premiums to manage their vanishing inventory. We are seeing a decoupling where the digital price becomes a fiction used to scare retail traders, while the physical metal becomes a trophy for those who can afford the gate fee. Geopolitical fuel on the fire. This liquidation isn't happening in a vacuum. On January 8th, the U.S. Coast Guard seized a Russian-flagged oil tanker. Iran is issuing warnings of preemptive strikes. The rules-based order is effectively dead. When major powers begin seizing assets on the high seas, the demand for non-sovereign stores of value, assets that cannot be frozen or canceled by a central bank, becomes insatiable. Silver and gold are the only assets that exist outside this weaponized financial system. Look at the oil-to-silver ratio. Crude oil is trading at $56 a barrel, while silver is at $78. It is historically rare for an ounce of silver to cost more than a barrel of oil. This anomaly tells us one of two things. Either oil is about to skyrocket due to Middle Eastern conflict, or silver is pricing in a total monetary collapse. In both scenarios, the paper sell-off on Friday is nothing more than a temporary distraction from a systemic fire. The empire of debt, the U.S. national debt, has crossed $38.5 trillion. The engine of the American economy is stalling, with job openings at their lowest level in a year. The Federal Reserve is trapped. They can either raise rates and bankrupt the government, or they can print money to monetize the debt. History shows they always choose the printing press. With Jerome Powell's term ending in May 2026, the administration is already vetting doves who will subordinate inflation concerns to keep the debt-fueled machine running. Silver at $78 is actually cheap when you adjust for the M2 money supply growth. If silver were to match its 1,980 inflation-adjusted peak, it wouldn't be $80, it would be over $700, while Wall Street trades paper contracts. The industrial world is facing a physical deficit that cannot be rebalanced away. Silver demand for solar panels and AI data center infrastructure is inelastic. You cannot build a high-speed processor or a high-efficiency solar grid without silver. There are no substitutes, even in a recession. These are political and technological mandates that transcend economic cycles. China understands this. While Western institutions are dumping paper silver to satisfy index requirements, Eastern powers are quietly absorbing every physical ounce they can find. They aren't looking at the 5-day chart. They are looking at the 50-year resource war. By allowing the paper price to be suppressed this Friday, the U.S. is essentially subsidizing the industrial rise of its greatest rivals. For the chartists among us, the noise of this Friday's liquidation should not obscure the signal of the 40-year breakout. Silver has spent 4 decades forming a massive cup-and-handle pattern. It broke the $50 resistance in 2024 and never looked back. In technical analysis, the longer the base, the higher the space. A 40-year consolidation doesn't end with a move to $80, it ends with a move that adds zeros to the price tag. We saw silver consolidate at $50 before jumping to $83. We are now seeing another consolidation. This Friday's BCOM rebalancing is a false break or a shakeout, a move designed to trigger algorithmic selling and flush out leverage before the next leg higher. The gold-to-silver ratio has already dropped from 1:0 to 1 down to 6:0 to 1. If this ratio returns to its historical average of 1:5 to 1, silver has exponentially more room to run than any other asset class. Friday is not a crisis for the long-term holder. It is a clearance sale. The question you have to ask yourself isn't whether silver will go down this Friday. It very well might. The question is, if the price drops but you can't actually buy any physical metal at that price, did the price really go down? We are entering a phase where the spot price is becoming a hallucination. The $4 billion paper liquidation is the smart money trying to trick you into trading your physical ounces for their depreciating dollars, precisely at the moment those dollars are losing their last bit of international credibility. Successful investors in this environment are not trading price movements. They are accumulating ounces. They understand that in a system saturated with $38 trillion of debt and escalating global warfare, the only thing that matters is what you can hold in your hand. Don't let a 5-day technical event blind you to a 5-decade structural shift. The clock is ticking toward Friday. The paper will be dumped, the algorithms will fire, and the media will scream crash. But for those who can see through the smoke, Friday is the warning shot before the real explosion. Are you holding the asset or are you holding the promise? Choose wisely, because by next week, the exit may be closed forever. What is your move for this Friday? Are you buying the dip, or are you watching from the sidelines as the physical market disappears? Let us know in the comments below. We'll be watching the tape. Stay sharp, stay informed, and we will see you on the other side of the liquidation.
The date is late 2025, and the silence in the silver market has finally been shattered. As you watch this, the financial world is waking up to a reality it has spent 40 years trying to ignore. While the mainstream media obsesses over Federal Reserve's soft landings and the latest AI-driven stock market surge, a far more dangerous game is being played in the shadows of the commodities exchanges. It is the great disconnect. On your screen, the paper price of silver might seem stable, but if you try to buy a physical 1,000-ounce bar today, you are met with out-of-stock notices in premiums that would make a Wall Street broker blush. We are witnessing a systemic breakdown, the moment where the paper-to-physical ratio finally snaps. The smart money, the JP Morgans and the sovereign wealth funds have quietly flipped their scripts. They are no longer shorting the market to suppress the price. They are vacuuming up every physical ounce they can find. You've been told silver is the poor man's gold. That was the first lie designed to keep you away from the ultimate hedge. The second lie is that you have plenty of time to prepare. Today, we are stripping away the propaganda to find out why the world's vaults are bleeding, and most importantly, how many ounces you need to hold in your own hands before the window of opportunity slams shut forever. Let's examine the crime scene of the 2025 financial year. The global silver market is currently in its fifth consecutive year of a structural deficit. We aren't just running low. We are facing an annual shortfall of nearly 200 million ounces. To put that in perspective, that is nearly 20% of total global production simply vanishing into thin air. First, consider the China factor. Beijing has stopped playing by the rules of globalism. Over the last few months, the Chinese Ministry of Commerce has implemented export license requirements for silver-related industrial components. By controlling the refining process, where China holds a near monopoly, they have built a silver dam. They are keeping the metal inside their borders to fuel their own dominance in solar energy, electric vehicles, and next-generation robotics. They aren't just winning a trade war, they are weaponizing the periodic table. In response, Washington has moved silver to its high-priority critical minerals list. The U.S. military-industrial complex is realizing, perhaps too late, that a high-tech military cannot be built on paper promises or digital digits. They need physical atoms for Tomahawk missiles, satellite shielding, and AI data centers. Finally, we see the corporate hunger. Massive tech conglomerates are no longer buying silver on public exchanges like the COMEX. They are executing iceberg orders, buying directly from miners through private offtake agreements. This means the silver you see priced on your trading app is a ghost. The real metal is being siphoned off market by corporations who realize their survival in 2026 depends on securing physical supply today. We are witnessing a bank run on the world's silver vaults, and the crowd is still asleep at the gate. To understand why this is happening now, we must perform a forensic analysis of the global financial chessboard. The US-China conflict is no longer about tariffs, it is about physicality. In a world of unlimited money printing and $36 trillion in US national debt, the only thing that retains value is what cannot be printed. China understands this. By hoarding silver, they are attacking the very foundation of the Western Green Revolution. No silver means no solar panels. No solar panels means the West's energy transition becomes a trillion-dollar failure. For decades, big banks used paper silver contracts, essentially IOUs, to keep the price low. They created a virtual supply that didn't exist in reality. But in 2025, the game changed. Investors began demanding physical delivery. When you ask a bank for the metal they promised you and they can't find it, the short squeeze begins. This is where the industrial black hole comes into play. The AI revolution isn't just about code, it's about hardware. The massive data centers powering the world's AI require silver for every connection and every circuit. When a company like Apple or Samsung needs 5 million ounces to keep their assembly lines moving, they don't care if the price is $30 or $300. They will pay whatever it takes to stay in business. This inelastic demand creates a vertical price spike that leaves the retail investor in the dust. The system is fragile. Your bank account is a promise from a bank. Your pension is a promise from the government, but an ounce of silver in your hand is not a promise. It is value in its most honest, physical form. It has survived every empire, every war, and every currency collapse in human history. The tragedy of the coming year is that most people will wait for the price to hit $100 before they decide silver is a good investment. But by then, the too late moment will have already passed. Too late doesn't just mean the price is high, it means the physical supply has been diverted to industrial giants and national stockpiles. The empires are moving, the corporations are hoarding, and the vaults are crying out for more. The question isn't whether silver will move, the question is, when that day comes, how many ounces will you be holding, and who will you have become in the process of acquiring them? Don't let your future be printed away. Write down your first milestone tonight, whether it's 10, 50, or 100 ounces. Start the habit. Convert the empty energy of impulse spending into the solid energy of physical ownership. The window is closing, the game is real, and the atoms are disappearing. Which side of the silver trap will you be on? Forget everything you think you know about safe haven assets. While the world was distracted by the festive lights of December, a silent earthquake just leveled the foundation of the global financial system. Look at your screens. In New York, on the COMEX exchange, silver is trading at roughly $72 an ounce. It looks stable, it looks predictable. But turn your gaze east. In Shanghai, that same ounce of silver is screaming at $78. $6. That is not just a price difference, it is the sound of a system breaking. In the world of veteran hedge fund managers, a 50-cent gap is an opportunity. A $1 gap is a red alert. But a $6 gap? That is a financial declaration of war. This isn't just a glitch in the matrix. This is the moment the paper empire of the West hit a brick wall, literally made of physical Chinese silver. Tonight, we investigate the heist of the century, how Beijing just reclassified a common metal into a strategic weapon, trapped the Western shorts in a liquidity coffin, and why the silver in your hand might soon be worth more than the paper in your wallet. The spring is coiled, and if you're still holding paper silver, you're not an investor, you're a hostage. This is the death of price discovery as we know it, and the birth of a new, ruthless era of commodity warfare. To understand how we got here, we have to look at the ghost in the vaults. For decades, the West has controlled silver prices through the COMEX, a paper market where most trades are settled in cash, not metal. It's a game of musical chairs where there are 100 dancers but only 10 chairs. As long as the music plays, no one notices the shortage. But China just turned off the music. Beijing has officially reclassified silver under dual-use export control rules. On paper, it sounds like bureaucratic boredom. In reality, it's a kill switch. By labeling silver as strategic, meaning it has both civilian and military applications, China has ended the era of automatic exports. Starting January 1, 2026, if you want silver for your solar panels in California or your Tomahawk missiles in Virginia, you have to ask Beijing for a license. And guess what? Those licenses are subject to national security review. Normally, traders would buy cheap silver in New York and ship it to expensive Shanghai to pocket the $6 difference. That's called arbitrage. It's the glue that keeps global prices together. But the glue has dissolved. China is locking its doors. They are absorbing the world's physical supply and refusing to let it leave. The COMEX vaults are bleeding dry, with registered silver, the stuff actually available for delivery, dropping to historic lows. We are witnessing the first global physical squeeze, and the West is caught with its pockets empty. This isn't just a supply chain disruption. It is the systematic dismantling of Western financial leverage. Section A. The Ghost of 1934. Why is China doing this? To find the answer, follow the bloodline of history. In 1934, the U.S. passed the Silver Purchase Act, artificially driving up silver prices to save American miners. It accidentally, or perhaps intentionally, drained the lifeblood out of China's silver-backed economy, causing a deflationary collapse that paved the way for decades of chaos. Beijing has a very long memory. They learned a brutal lesson. If your economy depends on a material you do not control, your enemies will weaponize it against you. Today, the roles are reversed. China isn't just a buyer, they are the refiners of the world. They control 80 to 90% of the processing for rare earths and a massive share of silver refining. They have spent decades building the Gold Corridor and the Shanghai Gold Exchange to create a parallel universe where the US dollar is irrelevant. Section B. The Inelastic Trap. Here is the forensic analysis the mainstream media won't tell you. Silver is what economists call an inelastic asset. Over 70% of silver is a byproduct. It's the accidental metal found while digging for lead, zinc, or copper. If the price of silver triples tomorrow, a mining company can't just dig more silver. They have to build a whole new copper mine, a process that takes 10 years and billions of dollars. Supply is frozen, but demand? Demand is a raging fire that cannot be extinguished by high prices. Section C. The AI and green energy chokehold. We're told the future is green and intelligent, but the green revolution is built on silver. Solar panels? Silver. Electric vehicles? Silver. And then there's AI. Every H100 chip, every massive data center being built by NVIDIA, Google, and Microsoft requires silver for high-speed conductivity. Unlike gold, which sits in a vault looking pretty, silver is consumed. It's destroyed in the process of industrialization. China knows that by controlling the silver supply chain, they don't just control a commodity, they control the speed of Western progress. If they restrict silver, they can literally slow down the US's AI development while accelerating their own. Section D. The BRICS Gambit. This is the us versus them moment. The BRICS nations, led by the dragon, are moving toward hard assets. They are tired of IOUs printed by the Federal Reserve. By forcing a higher physical price in Shanghai, they're telling the world the paper price in New York is a lie. If you want the real thing, you pay our price in our currency on our terms. This is the weaponization of the supply chain to force a global de-dollarization. So where does this end? We are currently in the vacuum phase. The gap between paper and physical is widening into a canyon. Eventually, the vacuum will suck the life out of the COMEX. When the big industrial buyers, the Apples, the Teslas, the Raytheons, realize they can't get physical delivery from New York, they will panic buy at any price. That is when the spring snaps. We've seen this before. In 1980, silver went from $6 to $50. But back then, we didn't have AI, we didn't have solar grids, and we didn't have a multipolar world war for economic supremacy. This time, the ceiling isn't $50. In a world of infinite paper money and finite physical silver, the true value is a number that would make most economists lose their minds. They are watching the vault outflows. They are watching the Shanghai premium. China has broken the market. But in doing so, they have revealed the truth. The West has been trading promises, while the East has been hoarding reality. The question isn't whether silver will go up. The question is, when the paper empire finally collapses under the weight of its own lies, will you be holding a receipt, or will you be holding the metal? What do you think? Is China's export control the final nail in the coffin for the US dollar's dominance over commodities? Or is the West hiding an ace up its sleeve? Drop your thoughts in the comments, and don't forget to smash the like button to help this investigation reach the masses before the dual-use gates close for good.